Okay, so let's start. We want to continue from where we left last time. Last time we were discussing the topic of published accounts, and I hope you still remember we said the following, just to remind you very fast. We said whenever a company is required to prepare published accounts, what should they include in the complete set of financial statements? One, we said the company should include a statement of financial position. Two, a statement of profit or loss and other comprehensive incomes. Number three, we said a statement of changes in equity. Number four, we said a statement of cash flow. And number five, they should include accounting policies and explanatory notes. So those are what we were calling the components of a complete set of financial statements for publication purposes. What are the components of a complete set of financial statements for publication purposes? Then from there, we went further and started looking at how to prepare each of them for the purpose of publication. When you are required to prepare published accounts, not, I told you, not for the purpose of internal reporting for your company, no, but specifically when you are preparing these statements for the purpose of publication. The first one we said, if you are required to prepare a statement of profit and loss, or what you can call an income statement, I hope you still remember we talked about the key issues. We talked about the key issues when it comes to income statement for publication. One, tukasema, of course you will start with the sales. That one there is no problem. Then we normally come to cost of sales, and we said when it comes to cost of sales, we said that figure for cost of sales should be only a single amount in the income statement. We say do the workings for the cost of sales somewhere, bring it as a single amount, whatever it is. Then you get the gross profit. Then we said when you are listing the expenses, we said those expenses should be classified according to their function. I hope you remember. And we said what are the categories of the various functions that may be performed in an organization? One of them is the administration function, where we said, go again as a company, combine all your expenses somewhere as a working, all the expenses that are of administration in nature, combine them somewhere and bring them to the income statement as a single amount. Then we also talked about the other function that may be performed in an organization is what we were calling selling and distribution function. Selling and distribution function. And in that case, we again said all the expenses that are relating to selling and distribution expenses, all of them should be combined again somewhere into a single amount, and you bring it as a single amount. Good. Then from there, we said you normally get what we called the profit from operations. Then from there, we said you minus the finance cost. For finance cost, I hope you do remember, we said when it comes to finance cost, we have two examples of finance cost. One of them is obvious, the interest charge for the year. Whatever is the interest charge, I have not said interest paid, I have said the interest charge for the year. We discussed this last time in detail. The other another item that can be considered as a finance cost is what we were calling preference dividends on redeemable. Preference on redeemable. I hope you have not forgotten. On redeemable preference shares, not on the non-redeemable. I hope you remember we said for the non-redeemable preference shares, their dividend is classified as an appropriation of profit. But we say dividend on redeemable preference shares, their dividend is classified as a finance cost, is classified as a finance cost. I talked about the difference in details in our previous class. Good. In our previous class, that's what we did. Okay, just give me a minute. Okay, so let's continue. So we said preference dividends on redeemable preference shares. We said they are considered to be preference dividends on redeemable preference shares. They are considered to be a finance cost. They are considered to be a finance cost. Then from there, we talked about the investment income. If you have an investment income as a company, that investment income could be in form of dividend received or interest income, whichever it is. Then from there, we said you get the profit before tax. Good. Then from there, we said you now come and charge the tax. One component of the tax is what we were calling the current tax, or what some questions would call corporation tax. That one I told you, the examiner will always give it to you, the corporation tax or the current tax, that one will be given. Then we said sometimes you may be required to adjust that corporation tax or that current tax with what we were calling deferred tax. And we said for deferred tax, there are times you add it to the amount of the current tax, or there are times you deduct it from the amount of the current tax. We discussed that in details last time. Once you do that, you get the net of those two. Once you do that, we said you get the net of those two. Good. Now, before I forget, I hope you are still remembering, listen, and because we have new students now, listen. Because we have new students now, listen to this important point. We said, in case you are disconnected because of your Wi-Fi strength, I'm saying this because we have new students now, okay? We said, in case you are disconnected because your Wi-Fi strength has weakened, we said, to come back to class, we said you don't click on the disconnected video. No. You go back to the group where the link was sent and you click on the original link that was sent to you. That way it will bring you back to class. If you are disconnected because your Wi-Fi strength has weakened, and so sometimes you may be disconnected. If you are disconnected, I'm hoping you still remember. I'm talking this because we have new students now who have joined today. And so for them, I'm saying, in case you are disconnected, we said you come back to the group, not by clicking on the disconnected video. No, but you click on the link that was either sent to the group or that was sent to you. The original link, you click it. That will bring you back to class immediately. I hope that point has been understood. So let's now continue. So I don't want to go back into the details of the deferred tax, but as we shall be doing a question, if it is part of the question, we shall just remind ourselves. There are many ways, I hope you still remember, there are many ways in which deferred tax could be tested. I hope you remember. We looked at almost 6 approaches in the language in which the examiner could use for deferred tax. Transfer to, transfer from, increase by, reduce by, maintain at, whatever. You remember that. But you either add, for all those languages, you will either add the charge for deferred tax or you will subtract the charge for deferred tax, depending on the question. Once you get the net of the two, that will give you what we were calling the tax expense. Once you minus the tax expense from the profit after tax, we said you get that figure called profit after tax. Another key important point, listen now, this is especially for the new students, just to remind you, or just to say, we said this. When it comes to income statement for publication, when it comes to income statement for publication purposes, we said you are not required. Listen to this point. You are not required to show the appropriations of this profit in the profit and loss account or in the income statement. No, you don't do the appropriations of that profit in the income statement. We said you will do those appropriations in a statement we were calling statement of changes in equity. Statement of changes in equity. Then we went further and said, if the examiner is asking you to prepare a statement of profit and loss or profit or loss and other comprehensive incomes, then we said now you come and identify other comprehensive incomes. Now you identify other comprehensive incomes. Good. We said one of them could be gain on revaluation of fixed asset. That is an example of what we can classify as other comprehensive incomes. Gain on revaluation of fixed asset. The other example we gave was what we were calling the exchange difference on translation of financial, exchange difference on translation of foreign currency transactions. Good. That is it. Then once you do that, you get the totals, and the total is what we were calling total comprehensive income. Good. Then from there, I don't have to go into the details of this. For the new students who have joined today, you can go to the previous videos. Of course, you can go to the previous videos and you watch and you get the details of how to determine interest. I don't have to go into the details today because today I want us to do a question. But we discussed about debenture interest in details. That is just to explain how it is calculated, blah, blah, blah. From there, we discussed about the redeemable and the non-redeemable preference shares, how to treat them in the balance sheet, how to treat them in the income statement and their dividend. That was important. So I'm saying for the new students who have joined us today, you can go to the previous videos and you listen to them. That's what we are saying. Good. Then we also talked about how to treat the debentures and the redeemable preference shares. From there, we discussed about this treatment of preference shares and dividends. That one we discussed. From there, here I can see we discussed in details concerning deferred tax. You can see there are many ways and there are many languages that we mentioned. From there, we discussed how to prepare what we were calling statement of changes in equity. Statement of changes in equity. And I told you a statement of changes in equity has various columns, and each column represents a component of equity. And so I said, when you are required to prepare a statement of changes in equity, you ask yourself, in this company, were there changes that took place in the current year that affects equity? Yes. One of them could be the appropriations of the profit. Like I can see, we said you normally start by bringing down the balances. I hope you remember, for each component. Then we said you bring in the profit after tax that you got in the income statement. Then you ask yourself, were there any appropriations out of that profit? Yes. Maybe we were paying dividends this year. How much? You deduct it from the profit. That one we also said it reduces the total equity on the extreme column. Another change, maybe this year as a company you transferred some amount of the profit to the general reserve. So those are two components. So we said you are removing money from the profit and transferring it to the general reserve. That one we said it has no effect on the total equity. Another transaction or another item that could have taken place and affects a component of equity is maybe there was a revaluation of fixed asset. Maybe there was a revaluation of fixed asset. And we said if there is any revaluation of an asset, of course you must have debited asset, you must have credited revaluation reserve. So when you created revaluation reserve is a component of equity, and so we said you show it under that column of the revaluation reserve. Of course, we said it will make the equity to go up. Then finally, another example we gave of a change that could have taken place, you remember, was if your company issued shares, and we were assuming, suppose the company issued shares we were calling bonus shares, and I told you when a company issues bonus shares, the capital of the company will increase. So you will go and increase the share capital of that company. But don't forget, we said whenever a company issues shares by way of bonus shares, those bonus shares must be financed from a reserve. They must be financed from a reserve. And we said, which reserve are we utilizing to finance the bonus? I told you the question will tell you which source of bonus, where is the source of bonus. It could be from share premium, it could be from retained profit, it could be from general reserve, it could be from revaluation. All those are kinds of reserves. And from our illustration, we were assuming that the question told you that you are financing your bonus from share premium. So it's like we had to debit share premium. In other words, take money from the share premium and take it to the share capital. Once you do that, we were balancing the accounts now, those various components. Good. From there, we talked about how to prepare a statement of financial position for publication purposes, not for internal reporting, for publication purposes. And you also remember there was only one key point when it comes to balance sheet for publication. There was only one key important point when it comes to balance sheet. The point was this, that when you are preparing a balance sheet for publication purposes, we said, do not come and tell us, or don't tell the readers of your financial statements that the value of motor vehicle was this, furniture was this, land was this, building was this, office equipment was this, and so on. No. In other words, we said, you don't list the fixed assets individually in the balance sheet. No. You don't list the fixed assets individually in the balance sheet. No. Instead, we said, you are required to combine all your fixed assets somewhere and bring them to the balance sheet as a single amount, That single amount, we said, is the one now which you classify as property, plant, and equipment. So any asset that qualifies to be part of the property, plant, and equipment, that kind of an asset, should all of them be combined into one amount. This is machinery, motor vehicle, furniture, land, building, office equipment, and any other. Then finally we mentioned and said, yes, as a company, you may have other fixed assets, which cannot qualify to be part of the property, plant, and equipment. That you may have other fixed assets that do not qualify to be part of the property, plant, and equipment. And so we say, if you as a company you have such assets, then now you can list them individually. We gave examples like goodwill. Of course, goodwill cannot be part of property, plant, and equipment. We mentioned other assets like investments. They are fixed assets, but you cannot classify them as part of property, plant, and equipment. We gave other examples like patents, copyrights, trademark. These are fixed assets, but they cannot be classified as part of property, plant, and equipment. So the requirement is, for those kind of fixed assets, you show them now individually. And we say, in most cases, these are like the assets you can call intangible assets. They are the ones you can call intangible assets: goodwill, investments, patents, copyrights, trademark. All those, like others like preliminary expenses, all those are intangible assets. Those are the ones you now show them individually. Good. I think from there we finished our discussion. Good. We finished our discussion, and today now I want us to do a past paper question now. I think I've reminded you what we did last time. So let me project a question here. Let me project a question here so that we do it, so that we now do it. The question I want us to do, just a minute. The question I want us to do is a question that came in November 2015. November 2015, that is the question I want us to do. That's the question I want us to do. It's a question that came in November 2015. It was question number 1. So I want us to do it so that we apply what we have learned, today. Good. So, of course, I forgot. I should have sent it to the group. Remember, today we have new students who have just joined for the free class. Today is a free class. But I should have posted the question to the group. I forgot. For those who have paid, don't mind. Today we are having others who have joined us, and they have joined us for a free class. But I'll share the question to the group. You know, whenever we have a question, I normally share it in the group of those who have paid. So I'll share it after class. So please, I forgot. Let's read the question. It says, Dollar Limited, a quoted company dealing in household goods, has prepared the following trial balance as at 31st of December 2014. In that trial balance, you are given the revenue, you are given interest, you are given purchases, you are given distribution cost, you are given administrative expenses, interim dividends paid, you are given inventory as at 1st of January 2014, you are given trade receivables and trade payables. Then you are given cash and cash equivalent, you are given ordinary shares, you are given share premium, you are given general reserve, and you are given the retained earnings. Let me roll the question. After that, after the retained earnings, what else? After the retained earnings, I can see that is general reserve. Then we have share premium, No, it means I have jumped. Let me go back. Yes, I think we were there. Yes, we were there. After share cash and cash equivalent, we had ordinary share capital. Then we have share premium, general reserve, retained earnings, 4% loan. Then you have the land and buildings. You are given the cost. In the bracket, you are given the land was worth 60, but both land and buildings, you can see in the column, they were 360. Then you are given the accumulated depreciation. Then you are given plant and equipment. You are given the cost and the accumulated depreciation. Then you are given something called investment property. Then you are given the rental incomes. Then you are given proceeds from sale of equipment. Proceeds from sale of equipment. Then let me roll the question now. From there we go to additional information now. We go to the additional information now. Number 1, they are saying the closing inventory as at 31st December 2014 amounted to 388 million at cost. However, shortly after the year has ended, some of the inventory, which cost 15 million, was sold for 8 million. Number 2, I'll talk about that in a short while. Number 2, land and buildings were revalued on 1st January 2014 to 800 million. Land amounting to 100 million and the building have a remaining useful life of 40 years. Number 3, the income tax liability for the year or in the year was estimated to be 20 million. Deferred tax to be provided at 7 million. Number 4, during the year, the company sold some equipment which had cost 15 million with an accumulated depreciation as at 1st of January 2014 of shillings 3 million. The item of plant was also estimated to be impaired by 4 million during the year. 5. Depreciation rate as per the company's policy are as follows. Buildings over the useful life period. Plant and equipment 20% reducing balance. The company's accounting policy is to charge a full year's depreciation in the year of the asset purchase and none in the year of disposal. The company treats depreciation of plant and equipment as a cost of sales, and on land and building as an administrative expense. Number 6, Dollar Limited values investment property at fair value. The fair value of the property as at 31st of December 2014 amounted to or was 586 million. Number 7. Let me roll it. Number 7 says, during the year, the company made a 1-for-3 bonus issue, capitalizing its general reserves. This transaction has not been accounted for. Next, required. You are required. Prepare in a suitable format or prepare in a format suitable for publication the following statements of financial position for Dollar Limited for the year ended 31st of December 2014. 1. Income statement. 2. Statement of changes in equity. Number 3. Statement of financial position. Statement of financial position. Good. Now, we want to go back to note number 1, note number 2, note number 3, and do the workings first. Before we prepare the income statement, we need to do the workings first. So let's go back to note number 1, read it, ask ourselves what do they want us to do or what are they testing in every note. Number 1, for example, they have said the closing stock as at 31st of December 2014 amounted to 388 million at cost. However, shortly after the year has ended, some inventory with a cost of 15 million was sold for 8 million. Let me explain. First, we are doing this question of November 2015. It was question 1. November 2015, question 1. Now listen, I want to explain note number 1. What are they testing there? They are testing on what we refer to as the accounting policy for stock valuation. The examiner there needed you to know, how do we normally value our stocks at the end of the year? How do we normally value stocks at the end of the year? I don't want to ask you that question because I know that from your financial accounting, you know how stocks are valued. In other words, what is the accounting policy on stock valuation? You know. That one you know. Let me just give it to you. You always value, stocks are always valued at the lower of cost and net realizable value. Stocks are always valued at the lower of cost and net realizable value. In other words, by the end of the year, as a company, you are supposed to value your stocks. Get the cost of your stock. For example, your stock by the end of the year had a cost of 20 million. That stock could realize. It can be sold, and from the sale of that stock, the realizable value maybe could be 25 million. Let me assume so. So if you have some stocks by the end of the year which had a cost of 20 and which has a net realizable value of 25, remember you have not sold them, but in case you sell this stock, you will realize 25 million. But by the end of the year, it has a cost of 20 million. So when you are valuing this stock, you are required to value it at the lower of cost and net realizable value. At the lower of cost and net realizable value. So it's obvious for this one, you will value it at 20. That is it. But of course, there are circumstances. We don't want to go into the details. I've told you, this is not something new to you. There are circumstances when you may have some stock which costed you 20 million, but for whatever reason, if you shall sell that stock in future, maybe you can only realize 15 million. That is your net realizable value. And this normally sometimes happens if the assets is affected by technology, blah, blah, blah. You know, change in technology can affect the value of an asset. But let me just assume that here is a stock which costed you 20 million. But when you shall sell it, for whatever reason, you will only realize 15 million. By the end of the year, you have not sold it. But in case you sell it, you will realize 15 million. So at what value will you value this stock? You are required that stock should be valued at the lower of cost and net realizable value. So in this case, you will value your stocks at 15 at the end of the year. Good. So I take you back to our question. In our question, listen to this now. I want to explain. Our company by the end of the year had stocks amounting to 388 million. That was the cost. By the end of the year, we had one bunch. Out of this 388, we had one bunch costing 15 million, which shortly after the year has ended, it was sold for 8 million. They are saying shortly after the year has ended because they want to tell you before the year has ended and just after the year has ended and before the accounts were published. That means before they were finalized for publication, something happened. We normally call it a post-balance sheet event. When you have a post-balance sheet event, before accounts are published, and there is a post-balance sheet event, then you are required to adjust the stock or the values of the previous year. But that's not the issue. The issue that you needed to know here is there is a stock which by the end of the year had a cost of 15, but its realizable value is 8. Not all the stocks have issues. Only one bunch out of it has an issue. It has a cost of 15, but it will only be sold for 8 million. So that bunch of stock alone you should not value it at 15. Instead, by the end of the year, it should be valued at 8. So before we publish the accounts, because it took place shortly after, some questions even tell you it is both of these figures are given to you by the 31st of December 2014. Unaambiwa by 31st December 2014, there is a stock costing 15 million whose net realizable value is 8 million. So they don't have to tell you even after blah, blah, blah. No, just by the end of the year, this stock has a cost of 15 million, but its realizable value is 8 million. We are saying that stock should not be valued at cost. It should be valued at the lower of the two. So for this question, the examiner wanted you to know what is the true value of the closing stock at the end of the year. What is the true value of the closing stock at the end of the year? It is not 388, no. So first thing, you have to take that 388, remove that stock which has an issue. And the stock which has an issue is worth 15. Don't try it first. Then you will get the closing stock that does not have any issues, which amount to how much? Let me minus 388. If I minus 15, that would leave me with 373 to be the stock without an issue. Then I come and say, there is another bunch of stock which has an issue. That bunch of stock costed 15, but because it has not been sold and it has a value of 8 realizable value, now you value it at 8. So you now come and add there the stock which had an issue to the one which doesn't have an issue. And that will give you 183. So the true value of the closing stock for this company should have been 381,000. I hope you are following. So that's what the examiner was testing you in this question. How to value stocks by the end of the year. That stocks should be valued at the lower of cost and net realizable value. Good. So I think now we can put down that working so that we now go to note number 2. I've explained it. Now we go to note number 2. So let's go and put down this note number 1. Andika hivi. We are discussing the solution now for number 1. Sema hivi for note 1. Sema hivi. Stocks should be valued at the lower of cost and net realizable value. Stocks should be valued at the lower of cost and net realizable value. Stocks should be valued at the lower of cost and net realizable value. Good. Then below there, now you can put down the workings. Below there, andika valuation of stock. Now we want to know the valuation of stock, or you can even close valuation of closing stock. Valuation of closing stock. Then you come and say your stock or cost. Put it that way. Cost of stock. Cost of stock without any issue. Cost of stock without any issue. We have said it's 388 minus what? Minus 15. 388 minus 15. That has given me 370 what? 373. That has given us 373. Let me put it right so that you see it clearly. We have said cost of stocks without an issue. 388 minus 15. That has given us 373. Then I've said now you add value of stock. Value of stock with an issue. Value of stock with an issue. value of stock with an issue. That one we have agreed you take it direct, 8 million. Then you get the total of value of stock now. Value of stock. Value of stock. Put it as 381. 381. That's what the examiner for that question was testing under note number 1. How to value closing stock. How to value closing stock. The stock should be valued at the lower of cost and net realizable value. So that stock which has an issue, remove it first. Get the stock without an issue, then add the one with an issue by correcting whatever issue the question wanted you to use. Good. So finish. We want to go to number 2 now. From note number 2, we want to ask ourselves, is there any working we can do? So for number 1, we are through. So finish. We go to number 2 and see whether there is any workings we can do for note number 2. Okay. So let me project note 2. Let's read it. It says, land and buildings were revalued. Land and buildings were revalued on 1st January 2014 to 800 million. Including land, shillings 100 million. The buildings have a remaining useful life of 40 years. Listen, we revalued both land and buildings to 800. For the land alone, it was revalued to 100. Remember, land, we are not depreciating it. So it means now, buildings on its own, the building on its own was revalued to how much? 700. I hope you are listening. Was revalued to 700. Then, now that the building was revalued to 700, we are told the building had a remaining useful life of 40 years. So one thing the examiner there is testing is, how much are you going to charge as depreciation on the building from now on? That's one working. The other working you need to know is, are there gains or loss on revaluation? Remember, we said in the statement of changes in equity, there could be a revaluation reserve. Okay? So that note also wants you to determine what is the gain or loss on revaluation. But before we even discuss about the gain or loss on revaluation, we obviously should be able to know how much from now on are we going to depreciate the building. Listen, this building, another key point, this building was not revalued by 31st December 2014. We are not revaluing it by 31st December 2014. By the end of the year, we are revaluing it by the beginning of this year. So it means this year we shall depreciate it. Get the point? If the question had said, land and buildings were revalued on 31st December 2014, then you don't depreciate it this year, you start depreciating it from next year. But the key point there was the date. When was it revalued? It was revalued on 1st January 2014, which means it was revalued as at the beginning of this year. And as at that date, it had a remaining useful life of 40 years. So let's depreciate the building first. Then before we do the other workings for the gain or loss, let's do the calculation for the building. So come and say, put down depreciation charge on building. Depreciation charge on building. That building alone had a value of 700 million. Remember, both of them, land and buildings, were revalued to 800. And the examiner has told you, land 100, meaning building on its own was revalued to 700. We divide that by the remaining useful life, of 40 years. So it means from now onwards, we shall depreciate our buildings by how much? We take that 700, we divide that by 40. That gives me a depreciation charge of 17.5 million. 17.5 million. Good. That's one. Now, I want to take you back to the trial balance so that you compute for me the gain or loss on revaluation. So let me take you there so that I challenge you. I see how much you will get as the gain or loss on revaluation. You can check the trial balance. Listen, that trial balance, look at it. We were told land and buildings cost 60 million. Oh no, 380 in bracket. Then in the bracket, land on its own was revalued was valued at 60 in the trial balance. Land and buildings, the column shows 380, but the value of the land alone was 60. So that one, there is no question about it. For land, I can tell automatically the gain is 40, because we were told by note number 2 it was revalued to 100, and the land was revalued and had a value of 60. So it's obvious land has gained 40. What I want you to calculate for me is the gain or loss on revaluation of the building. The note told us, note 2 told us, building was revalued to 700. When? By January. Building was revalued to 700 by January. So by the January this year, we shall calculate the gain or loss on revaluation. So I want you to calculate and tell me, I am giving you 1 or 2 minutes. 1 minute is enough. Start in that chart and give me by how much you think the land was, the building was revalued at. I want to see how much do you think is the gain on revaluation of the building. How much do you think is the gain on revaluation of the building? How much do you think is the gain on revaluation of the building? Take your calculator, look at that trial balance carefully, and then give me what you think is the gain on the revaluation of the building. Somebody is saying 444. Somebody is saying 444. Somebody else. What is the gain on revaluation of the building? Somebody else is saying 380. I'm talking of the gain. Don't give me the valuation. I'm seeing in the trial balance the land and building had a cost of 380. I've not asked for the cost. I've asked for the gain. Don't forget, note number 2 told you land and buildings were revalued to 800. We have already agreed land on its own was revalued to 100. Therefore, building was revalued to 700. So I want you to tell me, out of that 700, how much is the gain? Yes, the building was revalued to 700. But out of that 700, how much is the gain on revaluation? On the building, not on the land, on the building. That's what I want you to tell me now. On the building, what do you think is the gain? Somebody has got 444. Somebody else is giving me 380. I don't know about 444. We shall discuss it. But somebody else has given me 380. I don't think he's right, because I think he has just picked that value. I am not asking for the valuation as per the trial balance. I am asking for the gain or loss on revaluation. What do you think it is? What do you think is the gain or loss on revaluation? Take your calculator and calculate. somebody else has given us another 380. Hey, let me, I don't know. We shall calculate. I don't know. Somebody else has given me another 380. We shall calculate. We shall calculate. We shall calculate and see what is the gain. Okay. Now let me take you through now. Let me take you through now. Now, listen. This asset was revalued at the beginning of the year here, not at the end. As at the beginning of the year, the building had a cost of how much? That building. According to the trial balance, we were given the land and buildings, both of them at a cost of 380. So if I remove land of 60, I'm remaining with a cost of 320 for land or for building. Are you getting it? 320. Listen, but I cannot compare that 320 with the 700. That's where I think most people are getting 380. Listen to this now. But the examiner wanted you not to forget that by the same beginning of the year, that building had an accumulated depreciation of how much? 320 was the cost. 320 was the cost. Below that, I can see accumulated depreciation of how much? 64. So what this question wanted you to know, if the cost was 320 and the accumulated depreciation was 64, then the examiner wanted you to know what was the net book value of the building as at the beginning of the year. It is not 320. Yes, 320 was the cost, but it had so far been cumulatively depreciated by 64. So you had to know what was the book value by the beginning. So let me minus those two. I take 320, I minus 64, that gives me 256. 256. That becomes the net book value by the beginning of the year. Then it is the same beginning of the year that asset was revalued to fair value of how much? 700. So it must have made a gain of how much? 700 was the book fair value by the beginning. But the true value was found 256. So that gives me how much? 700 minus 256. That gives me 444. So there is somebody who has got it. According to the chart, there is somebody who has got it as 444. So the confusion there was that the examiner wanted you to forget and use the cost of 320 and you compare it with the book value, with the fair value of 700 to get that difference of 380. But the position is 320 is not the value of the building by the beginning. Yes, it is the cost, but it was not the true value of the building by the beginning of the year. Good. So let's put down now that working. Let's put down that working now. So let's determine, andika somewhere determination. Put it down, determination of the gain or loss on revaluation. 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 Okay, so I hope you are still remembering the issue about when you are disconnected, how to come back to class. I hope you are remembered. We have said you go back and click on the link again. I can see some new students have joined. It means there are those who are new, not new, but maybe who have joined for the free class. I have said, listen, I'm repeating. Especially I can see some new students have joined. I am repeating. If you are disconnected because of your Wi-Fi strength, and somewhere you are disconnected, we said, don't go and click on the disconnected video. Go back and click on the link that was sent to you. If it is in a group somewhere, go and click it. It will take you back to class. That original link that you received, that's the one you click, it will take you back. But if you click on the disconnected video, it will not take you back to class. No. Good. So let's move on. So I'll keep reminding you that if I see some new students who have entered. Good. So let's put down the gain or loss on revaluation. And we come and now say on land. Land, we have agreed there is no issue. We revalued the building to 100. It had a cost of 60. That gave me a gain of 40. That's okay. So you can say gain on land. Gain on land. Before we do the gain on the building, just come and say a net book value of building. Put it down. Net book value of building as at 1st of January 2014. Net book value of the building as at 1st January 2014. We saw it is 320. That was the cost. Minus 64. That was the accumulated depreciation mark Q. So it gave me some amount of what? Let me remember again. 256. 256 million. That is it. 256. That's what you wanted to know. The book value as at 1st of January. Once you knew that, now you come and see a gain on buildings. Gain on building. We take that 700 million. We minus that 256 million. We have agreed it is 444 million. 444 million. Good. That is it for that. That is it for that. Now we are through with note 2. That is what it was testing you on. So finish. We want to go to note 3. See whether there is something that we can do as a working. Or maybe it's just information that we can use direct. If it's something you can use direct, we don't do a working for it. No. So finish. We go to note 3. Okay. So let me project the question. We see whether there is anything to be done in note number 3. And as far as note number 3 is concerned, they are saying the income tax liability was estimated at 20 million. Deferred tax was to be provided at 7 million. That means they are saying deferred tax to be maintained at. In other words, deferred tax to be maintained at 7 million. For the other 20, that is just corporation tax, as I told you. That one we shall use it as we are doing the question. That one we shall do it as we are doing the question. We don't need that 20 now. But for the deferred tax, we need to use it so that we determine what is the charge for the year for the deferred tax. We are being told to provide it at 7 million. In other words, maintain it at 7 million. So let's open an account called, deferred tax. Deferred tax. Normally, we know deferred tax is always a liability. Deferred tax is always a liability. So we always start by bringing down whatever is the opening balance for the deferred tax. So let's go to the trial balance and bring down whatever is the brought down. We go back to the trial balance and find out what are they bringing down by the beginning of this year, so that we carry down, listen, so that we carry down the 7 million that they are telling us to maintain it at. So from this trial balance, how much was the brought down? That's what we want to pick. From this trial balance, how much was the brought down for the deferred tax? Are you seeing anything considered as deferred tax? From this trial balance, no. I can't see anything anywhere referred to as deferred tax. No. So in that case, we assume it's a zero. Just come and say a zero, no problem. The brought down was not there, but some questions do have it. Then wamekwambia maintain it at 7 million. So you come and carry down. Come and say your balance carry down. Remember, it's a liability. A liability is always a credit balance. Listen, a liability is always a credit balance, and you cannot have a brought down on the credit side without a carry down. That's why we normally carry down by the end of the year on the opposite side, so that when you bring it down, it will appear as a liability. So we come and say here, balance carry down, 7 million. Then I told you, normally the balancing figure now is what you take to the P&L account. The balancing figure is now what you take to the P&L account. And in this case, the balancing figure seems to be on this side and it becomes the same, 7 million. I want to believe from this double entry, for the students who are with us last time in the previous class, you will obviously should be able to tell me whether that charge, not the carry down, that charge, whether that charge of 7 million, we are going to add it to the corporation tax of the 20, or you are going to add. I hope by now you should be able to tell me where or how that 7 charge will be treated in the income statement. Don't forget, I explained it in details. For this one, just to help you so that we move to something else, I told you this. If you look at P&L account in a T form, in a T format, P&L, we said normally profit before tax is always a credit balance. Listen, then I told you it is out of that profit that we normally pay taxes. It's out of that profit that we normally pay taxes. So whatever is the corporation tax, normally it should be paid out of it. Whatever is the corporation tax or the current tax. So that one is always debited. So corporation tax or current tax, there is no question about it. That is always debited in the P&L account. It is the deferred tax that can either be debited in the P&L account or can be credited in the P&L account. Depends with the question. Like for example, this question, I have credited deferred tax by 7, which automatically means I am going to debit P&L account by 7. Now, we were told by this question that the corporation tax or the current tax was 20. And I've told you, corporation tax is always debited in the P&L. That one, there's no question about it. But now we are debiting another 7 in the P&L account. So the question is this. By debiting 7 in the P&L account, am I increasing the 20 corporation tax or am I reducing the 20? We concluded this way. When you debit an account which has another debit, we agreed last time, you are increasing the debit. When you debit an account which has another debit, you are increasing that debit. So for this particular question, we shall add the 7 to our corporation tax. Listen, otherwise we saw last time, assuming the 7 in the deferred tax was on the debit. Suppose we had debited and deferred tax by 7 as a balancing figure, meaning the charge. If we had debited deferred tax by 7, it means I would have gone to the P&L account and credited. That would be the double entry. I would have debited deferred tax, I would have credited P&L account. So I said, or I'm saying, if the corporation tax is on the debit, and then I come and credit P&L account now with the deferred tax of 7, I credit automatically. If I'm crediting this P&L, I am automatically reducing the debit. And therefore, when I'm doing it my P&L account in a vertical form, that 7 will be deducted from the 20. That's what I say. Then we looked at other languages that the examiner could use. Otherwise, that is all for this. Good. So for now, just copy the account called deferred tax. Just copy that account called deferred tax. We are seeing there is a charge for the year of 7 million. There is a charge of 7 million for the year for deferred tax. We have credited deferred tax. Automatically, it means you must go and debit P&L. You must go debit P&L. Good. So finish. We go to the next note. We are still looking for what else can affect the workings of this question. So that if there is a workings to be done, we do it. If there is no working, we just note. Good. Let me project the question again. We look at the next note. Okay, thank you. Next note says what? That is note number 4. Note number 4 says, I think number 4 and 5 are related. Yes, they are about fixed assets. Number 4 says, during the year, the company sold some equipment which had cost 15 million with an accumulated depreciation as at 1st of January. 1st January means the beginning of this year. 1st January 2014 of 3 million. An item of plant an item of plant was also estimated to be impaired by 4 million during the year. Number 5, depreciation rate as per the company's policy are as follows. Building over useful life, plant and equipment 20% reducing. The company's policy is to charge a full year's depreciation in the year of asset purchase and none in the year of disposal. The company treats depreciation of plant and equipment as a cost of sales item and on land and buildings as an admin expense item. That's okay. Now, note number 4. They are testing you on disposal of an asset. How disposal of assets affect P&L and affect balance sheet. It is obvious. Again, listen, that is not something new. You know, anytime you dispose an asset, as a company, you must determine the gain or loss on disposal of that asset. Anytime you dispose an asset, you must determine the gain or loss on disposal of that asset so that you take it to the income statement. And you also remember from your accounting knowledge, this is not financial reporting. No, this is financial accounting. You did that. So the examiner here is testing you on something you did in financial accounting. Determination of the gain or loss on disposal of a fixed asset. You know this For you to determine the gain or loss on disposal of an asset, there are many entries that you had to make. Many. In other words, there are many steps that are to be followed in the determination of the gain or loss on disposal. For example, obvious, you know, whenever you dispose an asset, that asset must be removed from the books of the company and taken to where? To an asset called disposal account. And that's always the first thing, that whenever you dispose an asset, step number one is to transfer the cost price of the asset from the asset account to the disposal account. That's always step number one, which I want us to take. And two, another point, you know, anytime you want to determine the gain or loss on disposal, you are opening several accounts. Maybe we can open them. One of the accounts you normally open is the asset account. What's the name of the asset? Let's go back and check. What's the name of this asset? We are told by note number 4 that the company disposed of an equipment. So let's go to the trial balance and see how much it was, that equipment. Good. From this trial balance, just below the land and buildings, I can see there is an asset called plant and equipment, which had a cost of 258 million, and that plant and equipment had an accumulated depreciation of 126 million. Good. So first we use those two. So let's open an account called plant and equipment. Plant and equipment. Then open another one. You know, you have done this before. You normally open another account called provision for depreciation. That one I hope you still remember. Provision for depreciation. Then you normally open another one. Another account you normally open is an account called disposal. Disposal. Good. So let's go through the many entries. In other words, let's go through the steps of disposal. Normally there are 4 steps. Listen, there are normally 4 steps. Step number 1 is to transfer the cost price of the asset sold from the asset account to the disposal. So, but before we dispose, bring down the cost of the asset. Go to the trial balance, bring down the cost of the plant and equipment. We are given the cost of the plant and equipment in that trial balance to be how much? The cost of the plant and equipment we are given as 258. Bring it. 258. So bring down that 258. The accumulated depreciation is 126. Bring it down. So go to the account called provision. Bring down that balance. That is 120 what? Let me confirm. 126. Good. 126. Okay. Now we move on. So step number 1 I've told you is to transfer the cost price of the asset sold. Transfer the cost price of the asset sold from the asset account to the disposal account. We were told by that note number 3 that this asset had a cost of how much? Note number 4, sorry, that this equipment which was sold had a cost of 15 million. So that's step number 1. Transfer the cost price of the asset sold from the asset account to the disposal account. So remove it from the asset by crediting the asset by that 15 million and you debit disposal. So come to the disposal account and you come and see your plant. 15 million. That's step number 1, which says transfer the cost price of the asset sold from the asset account to the disposal account. Transfer the cost price of the asset sold from the asset account to the disposal account. Good. That's step number 1. Step number 2, let me explain it first. Remember, as a company, you have been depreciating this asset. Before you sold it, you had been depreciating it. And that means out of this 126,000 depreciation, there is that depreciation of the asset sold. And the point is this, it is obvious. Once you sell an asset, you also, as a company, don't need to keep its depreciation in the books. No. Anytime you sell an asset, its depreciation also must be removed from the books. So step number 2 among the 4 steps of disposal, says, transfer the accumulated depreciation of the asset sold. From where? From the provision for depreciation to the disposal account. Transfer the accumulated depreciation of the asset sold from the provision for depreciation to the disposal account. We have been depreciating it. So what is this accumulated depreciation? As per the question, we were told it was how much? Note number 4 said that equipment had a cost of 15 million with an accumulated depreciation as at 1st of January 2014 of 3 million. Good. That is as at 1st of January 2014 at 3 million. Listen, and you remember the policy was none in the year of disposal. So even though we are selling it this year, we don't depreciate it for the period we have used. By the beginning of the year, we had an accumulator of 3 million, but we were told none in the year of disposal. So whether you have used the machine for 2 months this year before you sold it, or 4 months before you sold it, you don't depreciate it. No. So we use that 3 million as our accumulated depreciation. Remove it. That's what we want to do as step 2. It says, transfer the accumulated depreciation of the asset sold from the provision for depreciation to the disposal. So remove it from the provision. How? By debiting provision. Remember, it's part of 126. So you remove it by debiting provision and crediting disposal. And you come and see a provision for depreciation by 3 million. That's always step number 2 among the 4 steps of disposal, which says transfer the accumulated depreciation of the asset sold from the provision for depreciation to the disposal. We always debit provision for depreciation. Why? Because every time you depreciate an asset, you always credit the account called provision. You always credit an account called provision. Now that we are disposing it, remove it by debiting that provision and crediting disposal. That's step number 2. Listen carefully. Step 3 says, you record the cash received on disposal. I am reminding you these steps, but I do hope you still remember them as per your financial accounting knowledge. Okay? But step number 3 normally says, record the cash received on disposal. And I do remember, when we were reading the trial balance, I can see the last item up there from the trial balance. The last thing in the trial balance down there, I can see proceeds from sale of equipment. We sold it for 7 million. Good. So let's use it as our step number 3 that says record the cash received on disposal. We always debit cash and credit disposal. So come to the disposal account and you come and credit. That is 7 million. That's step number 3. That's step number 3, which requires you record the cash received on disposal. Step number 4 among the 4 steps is now to determine the gain or loss on disposal. Is now to determine the gain or loss on disposal. Listen, as a balancing figure in the disposal account, whatever is the balancing figure in this account, normally it represents a gain or loss on disposal. If I look at this account, the balancing figure looks to be on the credit side. Credit side we have 10, debit side we have 15. There's a difference of 5. That 5 goes to the P&L account as a balancing figure, mark you. it goes to the P&L account as 5. It is not something you have been given. No. Then you can ask yourself, is it a gain or loss? Again, because of time, let me just remind you that that is a loss. How can I tell that it's a loss? One way that you can tell it's a loss is by looking at the double entry of that 5. Remember, I have credited the disposal account. What does it mean? It means I must go debit P&L. Of course, any loss is always debited in the P&L. You cannot debit P&L account with a gain. Gains are always a credit balance in the P&L. So if the difference of 5 was on the debit of this disposal, then it means I would have debited disposal, I would have credited P&L. That would have been a gain. But this time, I am crediting disposal, it means I am debiting P&L. And any debit in the P&L must be a loss. That's one way of knowing it. The other way of knowing it is this, is to say, this plant costed us 15. By the time I was disposing it, it had lost value through depreciation by how much? 3. It means what? By the time I was disposing that asset, it had a book value of 12. If it costed us 15, and so far we had depreciated it by 3, it means by the time we were disposing that asset, it had a book value of 12. But we sold it for how much? We sold it for only 7. So if it had a book value of 12, and we sold it for 7, then we sold it for less than its true value. We must have made a loss of 5 million. Good. That's how we are determining whether the 5 is a gain or a loss. We have concluded it is a loss. Good. Listen carefully now, because we have come to another critical area in this item, Bado. Listen, I do hope you remember, even when you are dealing with this topic in financial accounting, that once you are through with the asset sold, the moment you determine the gain or loss on disposal, you did not just go and close now the accounts. No. Listen, you did not just go and close the accounts. No. I hope you remember there was one more thing you had to do. And what was it? Once you're through with the assets sold, listen, you had to depreciate the ones that are still remaining. In other words, you had to know, we have not disposed all the assets. We are still remaining with some. How much are we going to charge for them as depreciation this year? So once you are through with the assets sold, you had to depreciate the ones still remaining. So that is what we want to do now. But before we depreciate them, let's know how much are they. From the plant and equipment account, I come and carry down the balance. Let's do it. Come and see your balance carry down. What is the cost of the ones remaining? From this plant and equipment, the assets at a cost of 258, I subtract 15. That leaves me with assets costing 243 million, which have not been sold. We still have them by the end of this year. And so we have to depreciate them by the end of the year. Listen. So we want to ask ourselves, for these assets that are remaining, how much are we going to charge for them? Listen, for them as the depreciation charge for the year. Listen, I've just told you a short while ago, anytime you depreciate an asset, you have to debit P&L and you have to credit provision for depreciation. So we want to come and say here to the P&L account, to the P&L, how much are we charging as depreciation for those remaining? Listen, for those remaining, I can see their cost is 243. But to depreciate them, I need to know, listen, I need to know what is the policy of this company. Are they using straight line method? Are they using reducing balance method? Which method are they using to depreciate their assets? And what is the rate? That's what I want to determine. So that I say, okay, we are remaining with assets costing 243. What is the charge for them for the remaining, for this current year? Good. So let me go back to note number 5. I think it was note 5. That's where we were given the policy. Good. Number 5 says, depreciation rate are, as per the company's policy, are as follows. Building over useful life, plant and equipment, 20% reducing balance. Listen carefully now. 20% reducing balance. Listen. If they had told you 20% on cost, 20% on cost, then I would have just taken 20% of that to 43. I hope you are following. If they had said 20% on cost, I would have just taken 20% of that 243, because 243 is the cost. So if they had said 20% per annum straight line or 20% per annum on cost, I would have just taken 20% of that. Whatever I would have got, I would charge it here in the account called provision. But for this question, I cannot take 20% of 243. Why? Because the question says 20% per annum reducing balance. Reducing balance means you take a percentage on the book value, not on the cost, on the book value. Because of time again, I need to ask you, but I will not ask you, yes, these assets that have a cost of 243, what is their net book value? What is their net book value? If I'm able to know their book value, then it's on that book value that I would charge 20% on, because we are using reducing balance. Now listen carefully. I want to explain the details, because this is one of the areas you should be a bit tricked in financial accounting once you are doing this topic of depreciation. Listen. By the beginning of the year, we began the year with assets costing 258. All those assets costing 258 had their accumulated depreciation being 126. Okay? Then we sold one out of the 256, which costed 15. But that asset which costed 15 had so far been depreciated by how much? By 3. So what does it mean? If 126 was the depreciation of all the assets, including the one which was sold, their depreciation is in part of 126. Out of that 126, now we are realizing 3 million is the depreciation of the one sold. Out of 126, 3 million is the depreciation of the asset sold. So by implication, listen, by implication, if I can take 126 being the depreciation of all the assets, including the depreciation of the one sold, if I can take that 126 and I minus 3 million, which is the depreciation of the one sold, I'll get a balance of 123. Then I ask myself, that 123, what does it imply? It implies that it is the depreciation of the assets not yet sold. In other words, it is the depreciation, the accumulated depreciation of the assets still remaining. So now I know the accumulated depreciation of the ones still remaining as 123. I also know the cost of the ones still remaining as 243. Then it's possible now to get their book value. Once I know the book value, now I can get the depreciation because I'm taking 20% on reducing balance. And reducing balance says you apply a fixed percentage on the net book value. So the confusion of this question was that the examiner wanted you to take just 20% of the 243. That's not what you do. Why? Because 243 is not the book value. 243 was the cost. And I've told you, if the examiner had told us to use straight line method, then I would have taken 20% of that 243. But now I can't do it because I don't need the cost. I need the book value. Yes, I know the cost of those assets not sold as 243. I want to know what is their accumulated depreciation of the ones that have not yet been sold. So I come and argue by saying 126 is the depreciation of all of them, including for the one which was sold. So if I take that 126 and remove the depreciation of the one sold, that leaves me with 123 to be the depreciation of the ones not yet sold. Once I know the depreciation of the ones not yet sold, and I know the cost of the ones not yet sold, now I can depreciate, I can get the book value and then depreciate it. So let's put down that working or that thing as a working. So somewhere down there, andika determination, put it down, determination of the depreciation charge. Determination of the depreciation charge for the year. For the year, determination of the depreciation charge for the year for the assets still remaining. Determination of the depreciation charge for the year for the assets still remaining. So I want us to do it in form of some steps. Number one, andika cost. No, not cost. Put it this way, accumulated depreciation of the assets still remaining. Accumulated depreciation of the assets still remaining. Hapo chini take 126M minus 3M. 126M minus 3M. That gives you 123M. Now you know they accumulated. Then number two, you come and say to net book value of assets still, net book value of assets still remaining. We have agreed to get the net book value, you take the cost, you minus accumulated what? Depreciation. You take the cost, you minus the accumulated depreciation. We have already agreed the cost was 243M. That one we got it in the motor vehicle account or in that account. We minus what you have got in your working one, 126 million. So what does it give me? It gives me 243 minus 126. That gives me 117M. Good. Not 126, sorry. I am confusing you. It is 123, not 126, sorry. I just picked 126, but I had not seen 123. Sorry, it's 123. Put it to 123. Put it as 123, sorry, not 126. So that gives me an amount of 120, sorry. That is the book value of the ones remaining. Then number 3, andika depreciation charge for the year. Depreciation charge for the year. You now take 20% of 120 million. That looks like exactly 24 million. That looks like exactly 24 million. Good. Now that you know the charge, take it to the P&L account and in the provision for depreciation. Good. So finish. I want to take you back to the accounts. So number 1, we have got the accumulated depreciation of the ones remaining, 123. 2, I have used it to get the book value of the ones remaining, 120. Now I know the book value of the ones remaining as 120. I depreciate them using the reducing balance. I take 20% of their net book value. That is 24. Good. So we now use that. We now use that 24. Let's take it back to the account now. So take it to the account called provision for depreciation now. Take it to the account called provision for depreciation now. So we are debiting P&L and you credit this account called provision for depreciation and you come and see your P&L account. That is 24. Now you can close the accounts. We are through now. Already I've closed the machinery or the plant and machinery account. That one we closed it. Disposal, we have already closed it. So the only one remaining now is the account called provision for depreciation. What is the accumulated balance carried down? So let me add it. I get 126 on the credit side plus the charge for the year 24. I minus 3 million on the debit. I am carrying down 147. Good. 147. Sawa. So that brings me to the end of that note number 5, number 4 and 5, about depreciation and disposal. The examiner was testing you, the disposal, how to determine the gain or loss on disposal. For our question, we got a loss of 5 million. But once you get the loss, you don't stop there. I told you, you must determine the depreciation of the ones still remaining. Then I've told you, anytime you are disposing an asset, there are those 4 steps to be followed to determine the gain or loss on disposal. Number 1, transfer the cost price of the asset sold from where? From the asset account to the disposal account. Number 2, transfer the accumulated depreciation of the asset sold from the provision to the disposal. Number 3, record the cash received on disposal. And number 4, get the balancing figure in the disposal account to be either the gain or loss on disposal. Once you are through with those 4 steps, we have agreed you must depreciate the ones still remaining. How to depreciate them? Very important. What method are we required to use? Is it straight line? Is it reducing? I have told you, if it's straight line, then it's easy. Just go to your asset account, get them carried down. That will be the cost. Depreciate 20% of it. But if it's reducing, you must determine the net book value, which we have done. Good. Now, because we can't finish the question now, for my normal students, we shall continue from there next time. For my normal students, we shall continue from there next time. Otherwise, listen, for the new students who have joined us for the free class today, if you want to continue with us, listen, for that normal class, then you can call me on 0722 658875 if you want to continue with the normal class. Our classes for financial reporting are always on Tuesday, Thursday, and Friday at 8 p.m. to 10 p.m. That's the timing of the classes. Tuesday, Thursday, and Friday from 8 to 10 p.m. The charges are 4,000 shillings, but we also accept payments on installments. We also accept payments on installment. Otherwise, that's the charge for the unit until the end of the semester. Okay, so I have told you that if you want to continue with the class, especially for the new students, you can call me on 0722 65 8875. Classes are always on Tuesday, Thursday, Friday from 8 to 10. Now listen, the good thing about the system is even if you miss a class, listen, even if you miss a class and you want to still go and listen to that class, you can still go back and listen to it. Maybe you missed a class for a commitment you had somewhere. You just go back to the group where the link was sent, click on the link, and you can listen to the class again and again if you missed a class. Or maybe you are taught and you still want to revisit the video. You can still go back and revisit the video and listen to it again and again. That's the good thing about our system. It can help you review the topic again and again at your own free time. Some of us are behind. What do you do, please? Now, for those who will want to join, good. For those who would want to join, like I can see, Samuel says, for those who want to join, now listen. If you want to join, you can still get the videos. You can still get the videos of the previous classes. You can still get the videos of the previous class. Of course, we have covered some 2 weeks now. We have covered some 2 weeks. I've already done 2 topics, so you can still get the videos of those classes. I can give you the links. You listen to them. That's not a problem. So Samuel, if you want to continue with us and you want to get the videos of those classes, you will still get. You will still get. Yes. Yes, that's what I'm saying. If you want to join and you want to get the lesson 1 and 2 for published, remember, we have also done other topics. We have done the topic of branch accounts. We have done the topic of, which other one? Leases. We have done it. So we are saying, if you want them and you want to join the class, you will get those ones also. You will get the videos for the branch accounts. You will get the video for the leases, and even the lesson 1 and 2 for published accounts. And lesson 1 and 2 for published accounts. Okay. See you next time. I don't think I've forgotten anything. No, another thing. I would ask you to subscribe. I would ask you to subscribe to our YouTube channel. Even my normal students, please subscribe to my normal channel, YouTube channel, because that's where I stream into. Subscribe to that channel. Be a subscriber to the channel. So even for my normal students, if you have not subscribed in the channel, please subscribe. Please subscribe to the YouTube channel. Okay? You can subscribe to the YouTube channel and even like the video. You tick that you have liked the video. Otherwise, for the guys who have joined us today only, I want a comment. I want a comment. Samuel, what would you say? I hope you have got something. I hope you have got something. Samuel and others who have joined us today, maybe it's your free class of. For the freshers who have joined us today, let's hear your comment. You chat and tell me whether you have got something. Otherwise, we shall continue from there next time. If you want to join us, I've given you the number 0722 65 75. 0722658875. Very good, class. Okay. Very, very good. Very clear. That's what I also wanted to ask. Whether the sound was quite clear. Whether the sound was quite clear. That's also something else I wanted to find out. 2, I've told you, whenever you are disconnected because of your internet strength, go back and click on the link again. Subscribed and liked. Thank you, Sharon. Thank you, Sharon. Thank you. Sawa. So see you next time. For those who want to join us, that is it. You can call me or text on those numbers. If some of you, listen, if some of you have friends who are doing advanced financial reporting, I'm also teaching it, they can also call me. If you have friends who are doing advanced financial reporting, we also have a class for advanced financial reporting. You can let me know. Thank you. Sawa. For the past papers, listen, somebody's asking for the past papers. I don't have to share them. What you can just do, this one I'll give you. But for the other past papers, just go to the Google. Just Google and say, CASNEP past papers. There are many sites that will give you the freedom to download them. If you want past papers, just go to Google and Google CASNEP past papers, CPA CASNEP past papers. Choose one of the sites that have presented them well, and you download as many as you can for various years. So getting the past papers these days is not very hard. Just Google. There are many sites that give you for free. Okay? Sawa. No, physically, we are not in any college. Physically, we are not in any college. We are only doing online. I am only teaching online class. Only online. Okay? Somebody is asking where we are physically. No. For now, I'm only teaching online classes. That is for financial reporting and the advanced financial reporting. So if you want, you can join the online. The good thing is, I've told you, Sophia, I've told you, don't panic that you can miss a class. I have told you, if you miss a class, you can go back and listen to the video as many times as you want by going to the group and clicking the link again. That should not panic you. That maybe one weekend, maybe on a Friday, there is a function you have to attend and you count you have missed that class. No. You can go back to the group after your function or even the following day and listen to the video that you missed. Good. Thank you. Good. Thank you. Alphonse says, thank you. You have for the good and clear lecture. I am continuing. Welcome. So call me on those numbers. The charges are 4,000. We accept payments in installments. We can talk and so on. Otherwise, good night, everyone. Good night. See you next time. Unless there's another burning question. Unless there's another burning question from somebody. Okay. I hope there is none. Otherwise, see you next time. See you next time. Bye.